Andrew's first idea is a storage vault, SVI.
Yeah, I went with a bit of a theme here for my top picks, and that is essential service type companies. So the first one being Storage Vault. This is the only public storage company in Canada. It's not a REIT, a traditional REIT. It's an operating company. It's quite unique because they've got a very good, strong organic growth profile, but they also have an accretive acquisition model. So very fragmented industry in Canada and actually across North America, but very fragmented, lots of opportunities to buy mom and pop storage companies across Canada. They've got a very good platform already. They target 4 to 6% consistent same property NOI growth. And it's a need-based business. So there's plenty of reasons for individuals and families and also enterprise to actually own and use or rent and use storage facilities. So it's a shorter lease term for them as well. So rather than, an industrial property that might have a 7-year lease term, these guys typically have a 1.5 to 2 year lease term. So that allows for price discovery. So as lease rates start to trend a little bit higher, they can tap those rates with the occupancy coming in and out of their buildings. So they've managed to keep their cost of capital extremely low. They're diversified and in their geographies, and I just like the business model altogether. So that's the first one. I feel it's reasonably defensive, and the stock price is about 16% below where it was trading in February. So there's still some good room to even catch up to where they were in the beginning of last year.
Your next idea is Waste Connections.
Yeah, Waste Connections, another very defensive business. So they run obviously waste and refuse collection and services throughout North America. It's a business model that works in pretty much any economic cycle. It's defensive when the economy is shifting into a lower gear, or maybe if we were to see a recessionary environment materialize next year. I think Waste Connections is going to be one of those few companies that hold up reasonably well. They do have contracts with enterprise and specifically with energy companies, and that may suffer a little bit. But if you think about it, waste needs to be collected every week or every consistently, and these guys run a lot of different collection cycles across North America. They've got an acquisition strategy as well. So not only do they run a very efficient business, they also look for accretive acquisitions. So I think it's a really interesting one. And given the outlook that we have for the broad market to be, we're a little bit unsure of in the broad market, I think this one is one that you need to own. We've owned it for as long as I've been with LDIC, and that's over 13 years. So long time holding for us.
I know people say, well, residents will need to get rid of their garbage, whatever happens to the economy, but aren't they dependent, though, on industry and commercial customers' refuse volumes that could turn down?
They are for sure. It's a lesser part of the overall business. They are for sure, and that's where I point out the enterprise allocation there to their structure, and certainly energy is a big part of that. So. That part will be a little bit more volatile if we do get into a downturn, particularly on the energy side. But overall, generally speaking, a very defensive model.
Okay, and your final idea, WSP Global, the big engineering company.
Yeah, so another one that we've owned for a long time, global engineering consultancy. You don't have to look too far to see infrastructure development, even here in Toronto. This is going to be required. It's consistent, government and enterprise, both developing infrastructure. And they're about 50-50 split between government and enterprise. And this company has grown into a massive organization. And they've got a footprint in most OECD countries. And so that gives them local expertise. So you're looking at different operations happening all over the globe. You might be looking at a project in Australia and using the expertise there for another part of the world, and it really gives them a great, a consistent competitive advantage with their peers that might be just more local peers. So that's a big one. They don't have inflationary pressures similar to the contractors. They're asset light. Their business model is essentially just the people, where their big expense and their asset is the people that work for them, the engineers. So they've got a healthy backlog. They've got over a year of revenue in the backlog, which is supports long-term growth. And it's just been a consistent company. And another company that also relies on M&A. So every few years, they'll do a very large strategic acquisition. And in the meantime, they'll do a bunch of tuck-ins. And typically when they do a large acquisition, that resets the price. You'll see it gap higher. They'll justify the acquisition with a bunch of synergies, and the market and analysts will re-rate this thing, and it typically gaps higher. That becomes the new baseline. So we'll look for that because the balance sheet is under 2 times EBITDA, which is pretty healthy. And so we'll look for them to do an acquisition reasonably soon. They don't give away the exact timing, and it depends on market conditions. But, you know, it happens every few years.
Andrew, thank you very much indeed for joining us. Let's get to those top ideas. ARC Resources, the natural gas specialist.
Well, they are natural gas, but they're also oil and liquids as well.
Right.
You know, I think in terms of their exposure to natural gas, it's probably around 60 or 65%. And the other, you know, they're primarily operating up in the Montney area in northern British Columbia and Alberta. It's an extremely well-capitalized company, and they do, over time, give back about 70% of free cash flow to shareholders, either through dividends or buybacks. They, you know, surprised everyone lately with their new CapEx plans, which were a bit lower than people thought, but nonetheless, they say it's going to grow their barrels per day growth from, well, a modest amount increase, but still they pretty consistently increase their production. So as I said earlier, I'm fairly bullish on the energy area. We anticipate that they're still going to continue to give a large amount of that free cash flow back to shareholders, and I think that it's a good stock, a good core stock to hold in the intermediates.
Okay, your next idea, George Weston.
Yeah, it's been a while since I've recommended Weston, but we've owned it all the way through, had our ups and downs. I guess we like it. We like the fact that, you know, they are primarily Loblaws and Choice Properties. We like Choice Properties because they have that good, solid grocery tenant base. I think that, you know, staples are a good place to be, but they also give you fairly good exposure through Shoppers Drug Mart to that side of the market. So overall, we think that it's selling at a reasonable prices today. It's got good long-term growth prospects. You know, the only thing that's controversial about it, I guess, has been coming from the mouths of politicians lately and on pricing and so on. But pricing's not something they control as much as the politicians could control it. So I don't blame them for that.
What do you mean, Loblaw?
Well, I mean, if we got rid of the marketing boards, all of a sudden, price of food in Canada would be a lot cheaper than it is today.
Quite true, certainly on dairy and eggs and things like that. Yeah, that's right. But they don't like to talk too much about that because of the votes in Quebec and other.
No, and the other side of it, you know, they're having a lot of cost pressures. You look at the transportation costs of getting the goods to market because of the increase in the price of energy.
Interesting.
And they're being hit on the human resources side with demands for higher wages too. So there is some cost pressure there.
We have finally Enbridge. Enbridge would be one of your favorite pipelines.
Yes, it would. And you know, we think this is a good long-term pipeline to own. They own a very large pipeline in North America, pipeline network. I guess, you know, recently we saw the stock pull back a bit when they made the purchase of 3 utilities in the U.S. from Dominion Energy, and there was some question as to how they were going to finance that, but they did successfully fill that gap, well, almost fill that gap, with a large equity issue in both equity and in some hybrids, and they sold a 50% stake in their Alliance natural gas pipeline, and a stake in Osable, the U.S. assets to Pembina actually bought them, which made sense because it integrates in well with their network. So we think that they have a considerable backlog of projects over the next couple of years, and expect their dividend to increase.
Okay, and the yield right now, about 7.4%. Yeah.
Yeah.
Stock has rallied about 3% this year. Michael, thank you very much indeed.
Thank you.
Let's get to, we pointed out Stan Wong is coming on. ARC Resources, your first idea here, natural gas specialist.
Yeah, so we've talked a lot about natural gas today, and hinted at this a few times, but ARC Resources is the pick here. So obviously hit, a tremendous, if you pull up a longer term chart, tremendous run over the past few years from $6 where we were buying it for clients to 23, recently pulled back below 20, it's up a bit today. Like I said earlier, we might get some commodity price softness in here, but if we do, you want to be looking at buying these shares below $20, I think. On a long-term basis, this company has a really strong opportunity set. And the two things are, yes, the natural gas side and LNG Canada, but it's really the condensate, which also helps with the diluent to flow to Trans Mountain, the bitumen that's going to be flowing to Trans Mountain, as well as other places. But their condensate exposure is really important. Condensate trades at a premium to WTI, especially in Canadian dollars. It's really attractive. And they own a lot of their own infrastructure, which insulates them from some of the commodity price swings. So I think you're going to see the free cash flow yield on this thing is mid-teens. You're going to see dividend increases. They've got organic growth. They don't need to buy anything. This is a company I think you can own for a long time. And so anywhere in the mid to high teens, I like it. $20 is kind of the level where we start looking at it again. So,
Manulife Financial.
Yeah, so Manulife, if they can, sorry, I should have asked the control room, I'm putting them on the spot, but a long-term chart of this company, it's breaking out of a more than decade-long range. It's bounced off.
5-year or 10-year chart even?
Yeah, even a 10-year chart.
NPI, okay.
Even longer,
sorry,
actually.
MFC, yeah, carry on.
So it's bounced off the kind of $28 level a bunch of times. There you can see it there. This
nice,
is a pretty good chart. And you can see that breakout there on the far end. Now, we talked earlier about technicals. I'm not a big technicals guy, but it is interesting to see when these things happen, right? We finally have some fundamentals on their long-term care portfolio. They did a deal, I guess it's a reinsurance deal, where the value they got for that was much better than what the street expected. There's still more work to do there, but now we have a path, right? And the underlying business is actually performing pretty well. We'll see on Asia. There's some dynamics both ways there, some potential risks. But your 5% yield, it's not expensive. I think, when the institutions start to get behind this company again, this is when you see these step changes in these big companies where all of a sudden it's $35 and you're going, okay, that big money moved in and they're sticking with it. We'll see if that happens. That's not necessarily our thesis, but that's kind of the way we could see it going, and we own it, and we like the yield in the meantime and the optionality going forward.
Reg in Winnipeg, one of our Manulife fans, will be happy to hear you saying that. Northland Power.
Yeah, so met with them this morning as well. There's a conference in town, so I met with a bunch of companies. Pretty tough year for them last year. Pretty much everything went wrong from a sentiment point of view around renewables, and then rates kind of compounding on top of that. Plus, you had the problems at the turbine manufacturers. So we're pretty confident that Northland Power can do a good job executing these projects. Execution has been what they've done well. Nobody believed they could do what they did 10 years ago in the North Sea, and they did it. Now they've got Baltic Power is within the supply chain. I think they can do it. The Taiwan project, which everybody's concerned about, they've offloaded a big chunk of that. It's reached financial close. The engineering and construction has already begun. They've assured us on timelines and how they're getting materials there well ahead of time in case there were to be shipping disruptions. So I think they're taking steps to mitigate it. And on a long-term basis, I don't think renewables are gone off the map. So we'll see. But I think at these levels, you're not paying for, you're getting a lot of optionality in today's share price. And so, and a decent running yield, 4.5%, 5%, I think. We'll see what happens. It's a riskiest of the three recommendations, but we own it. We own a lot of it. We've owned it from $16 all the way up to $50 and all the way back down. We're buying more of it at these levels, and we think on a long-term basis it's worth more than it is today.
Ryan, thank you very much indeed. First idea, MasterCard.
Thanks, Andy. MasterCard is one of our core holdings. It has revenue projected for 2024 revenue of over US $28 billion. They've grown their revenue by about 10% annualized over the last 5 years. As you know, it's the second largest global digital payments company in the world after Visa. It operates in over 210 countries and in more than 150 currencies. I think long term, when you look at the global payment companies such as MasterCard, solid consumer spending, growing spending, strong travel demand, and higher cross-border transaction volumes, these are all things that are lifting the prospects for companies like MasterCard and Visa and so forth. Longer term, MasterCard has one of the best extensive global networks, obviously very strong brand recognition, and they've got great technology behind it. Allows it to be sustainable. It allows it to have very strong competitive advantages over smaller players, and they're able to protect their market share and profitability. Generally speaking, the industry has plenty of runway for growth. As I said earlier, more and more of the developing countries are moving into digital payments and credit cards and debit cards and so forth. It truly is a total booth business. They earn transaction, network, and licensing fees, regardless of whether or not you're using a credit card or a debit card or your mobile app and so forth. Just last month, management announced a new $11 billion US billion share buyback program, and they raised their dividend by 16%. Going forward, we think that earnings growth looks to be about 17% or more over the next several years. So great growth at a reasonable price name in MasterCard, great core name in the portfolio.
McKesson, the big drug distributor, that stock near record highs.
Yeah, a name that's not really well known out there, but it is one of the largest pharmaceutical wholesaler engaged in the sourcing and distribution of branded, generic, and specialty pharmaceutical products and medical products. We're looking at about $305 US billion in expected revenue for 2024 fiscal year. Its largest customers include CVS and Walmart. They basically are the distributor, they're the middleman between the pharmacies and the medical product companies and the end retailers such as CVS and Walmart and so forth. They basically operate in a virtual triopoly. They share the market share with Cardinal Health, which is a name we also own, and Cencora, which is another name out there. There's really only just 3 players that distribute the drugs from the drug producers into the pharmacies and so forth. Long term, I think the demographics makes a lot of sense. Aging population should result in greater spending volumes for prescription drugs. Nearly 60% of Americans use at least one prescription drug on an ongoing basis. That number is going to rise, especially when you consider the fast-growing demand for diabetes drugs and also weight loss management treatment drugs. Just back in August, management increased the share buyback plan by US $6 billion. So obviously that's shareholder friendly. They beat their analyst expectations in its recent quarterly results. They beat on the top line and the bottom line and raised its guidance for full year fiscal 2024. You've got a great chart in this stock. As you know, it's trending higher highs, higher lows. Share prices above the 200-day and 200-week moving average. Can't get a chart that's better than this. The shares have been outpacing the S&P 500 since early 2019, so quite some time. And we're looking at about earnings growth rate of about 10% forecasted going forward. So a great steady name, not a lot of competitors in this space, solid type of healthcare name to own.
Oh, okay. And then your final idea, O'Reilly Automotive, ORLY.
Yeah, so again, probably not well known out there. It's basically the largest specialty retailer of automotive aftermarket parts, tools, supplies, equipment, and accessories in the United States. They've got over 5,900 stores. We're looking at about $17 billion in forecasted 2024 revenue. They've grown their revenue in the past 5 years by about 10.5%. They basically sell parts to do-it-yourself customers, professional mechanics, and service technicians. Long term, the tailwinds are behind a name like O'Reilly. There's a growing need for maintenance and repairs due to the aging automotive vehicle fleet in the U.S. The average age of a car or automotive vehicle in the U.S. is about 13 years at this point. It's at record highs. So we're going to need more parts to fix cars as this aging fleet of U.S. cars continues to age.
13 years, yeah.
Yeah, so I think people are holding on to their cars, probably looking at the economy and being very careful for how they're spending. We've seen a bout of inflation in the last few years and interest rates being high, so people have been hanging on to their cars. And it's really a resilient business. This industry is very resilient. You've got to maintain and repair your car no matter what. If you want to get somewhere, you got to go to work and so forth. So really, any type of economic environment, a name like O'Reilly has done well. Just a couple months ago, they increased their share purchase program by $2 billion. Again, shareholder friendly. We expect about 12% earnings per share growth rate going forward over the next few years.
Okay, thank you very much indeed.
Appreciate it. Great to be here.
First idea, Oshkosh Corporation, heavy vehicles, including military vehicles.
Yeah, this is a great industrial company. It's on the smaller cap side, I think 6 billion, 7 billion in market cap, but wonderfully diversified in what they do, and they use a lot of technology. So this is not just manufacturing. This is using technology, state-of-the-art technology, and really driving the business. They've been very good acquisitors and stewards of capital in the past. They said that they should do $9.50 in earnings per share for 2023. I think it's going to be better than that when they report, I believe, later on this month. We think that they could grow earnings at 10% to 15% per year. So on a next 12-month earning basis, this is a stock that trades at 10 times earnings or less. And they're in the sweet spot, in our opinion, given you've got the Inflation Reduction Act money that's going to be dispersed, you've got the CHIPS Act money that's going to be dispersed, and you've got 2 theaters of war. And so they do some defense contracting for the U.S. military.
Oh, yeah.
So we think that this is a very interesting security, and we, full disclosure, just bought it yesterday on the pullback.
They make those famous MRAP giant vehicles, which I just learned stands for Mine Resistant Ambush Protected.
Yes.
Okay, after all the IEDs in Iraq, they had to, I think it has a bottom like that to generate the explosive away. Capital Power, the Alberta energy or electricity producer.
Yeah, so this is a very well-run power producer, pays an extremely nice dividend, which just got bumped late last year. They've been increasing the dividend by, I believe, 7% a year. They said that they're going to continue increasing the dividend based on their last projection at 6% a year, at least for the next couple of years. You've got a current yield of, I think, approximately 6.5%. But what really caught our eye was the fact that they made a very big acquisition in conjunction with BlackRock just late last year in some power assets in the U.S. That's on top of a 50% interest in the Frederickson generation assets. They now have 30 locations across North America. And what we also like about this one is they've got very little maintenance capex required for their facilities, which means that they generate a ton of free cash flow. And their net debt to EBITDA is not very high when you compare them to an Enbridge, for example, or other sort of utility/infrastructure power producers. So they've got a lot of levers to pull, a lot of free cash flow potentially ability to buy back stock or make more acquisitions.
Right, and a yield of almost 7%.
Yeah.
Charter Communications, the US cable giant.
Yes, this is a wonderfully run company serving 32 million customers across 30, 40 states in the United States, broadband, mobility. They're in the sweet spot of what everybody needs. Everybody's got a cell phone. Everybody's got internet access, both in their business and in their home. We think they're doing all the right things. They're buying back stock. They're not levered up the wazoo, meaning I think it's 4.5 times net debt to EBITDA. They have a plan with some CapEx over the next 18 to 24 months, at which point we think their CapEx cycle to a large degree will be over and they will be generating a ton of free cash flow. So it's cheap on its own merits, but if interest rates go down even lower, as we believe they will, then the fair market value can actually escalate from what we think it is today.
And your final idea for us, you had heavy vehicles, you had electricity. Oh, that's it. Oh, my goodness. Time goes so quickly. I'm sorry about that. Mike, thank you very much indeed.
Thank you for having me. It was a pleasure.
Mike Vinokur.